How are you doing, Faizan?
I'm doing good, man.
Um, Faizan, I'm still curious. I have no idea what you picked to talk about today.
Oh, so this whole thing kind of spawned from the idea of like, hey, I know you like talking about stocks. I know you like
Yeah.
getting something about finance. And it's like, hey, can you talk about the financial markets? And it's like, I mean, I can kind of talk about them. I'm not an expert, you know? Like definitely not at that level, but I would say probably know a little bit more than the average person. I think what I kind of ended up on doing was like, oh, you know what? I'll talk a little bit about like how I mostly derive like entertainment from the financial markets, and then some idea of like my journey as like a total amateur retail investor.
hmm
I'm sure people have even heard the words retail investor, but like,
I've never
what
heard
does
of
that
it.
mean? Like, what does that mean? Compared to someone else. So things like that. I figured it might be just kind of fun to talk about it and see the questions that you ask. You always ask such great questions.
Yeah, that sounds pretty awesome to me. I'm always poking you a little bit for stock quotes here and there, and we've never really sat down and purposefully talked about it. And as always, the pitch is have the conversation you want to have. Like you don't have to come across as an expert in any sense of the word. In fact, in episode 3, I was chatting with Alex about Seinfeld, and
Yeah.
there was no expert conversation.
That was a fun conversation though. That
Yeah,
was very
yeah,
fun.
it was really fun. It's hilarious. Where do we start, Fazan?
um
What age were you when you first heard the word stock?
I was a lot younger. It was high school and like I heard the term and it always just seemed something out of reach and it's like, oh, people get rich off of that or something. And it's like it seems pretty untouchable. I think college was my first real area of getting in there and be like, you know what? I think I can open up a stock account. I can buy like ownership in a company that I think is gonna do well, like, all of these things because I have found myself even as a young person, even as a teenager, being opinionated and like, hey, you know what? I think this thing is going to do well. Uh, so like when I was in high school, when I was really young, it was like very, very like distilled, very like small opinions about like, oh, simple thing that everyone knows, but like I wouldn't necessarily see reflected everywhere. So for example, like, you know, um, just as a gamer, like you have like these Intel chips that are going to be coming out with like a new chipset, and everyone's like maybe attracted to the AMD chipset or something like that. And it's like, oh, why aren't people thinking about this? So it was just like me thinking about little things like that. And since I've always thought about that, I think college is kind of the transition that I took. And I'm like, okay, cool, I'll open up a stock account. And when I did open up a stock account in college, it was great. I had the greatest ideas. I was like, "Oh man, this oil thing is going on right now." I think it was back in 2014, and the price of oil had like plummeted. I don't remember the exact phenomena going on, but I was like, "Oh, dude." Everyone always says, you got to invest for the long term. I should just buy these companies that are like distressed, and I'll be doing great. So I put in, some money and it was great because all I did was proceed to lose like 30% of it.
How much money are we talking here?
It wasn't that much. I think it was around like I want to say it was around like $1,500 or something like that, 1,500 or 2,000, something like that.
That still sounds like life savings for a college student or a teenager.
Yeah, I mean at that point I had been like, getting money from like research and from like other jobs I had been doing in college and I'd put it in, but it was one of those things that cool, you lost like 500 bucks, 600 bucks. Like I was looking at it more from like, oh, the experience that I'm getting. I think that's how I really saw it. Um, and that's kind of what it has evolved to, right? Like I think what has really attracted me towards like this field of like, um, whether you want to call it equity or financial markets, it's like it. Some point it feels like a game, right? But it's being played at like a completely different level, and it's I think like a very fascinating intersection of like psychology, numbers, s- even think of it as sport and like world events and like all the interconnectedness of world events. Um, it's like a proxy of like how the world works. And one thing I like about it, I don't know if other people like this, but I think it keeps you humble. As an investor, you make like a hypothesis about situations, company, and the world, right? And you'll see people talk about this all the time. They're like, "Oh, I think the world's gonna do this." It's like, cool. Why don't you put your money where your mouth is? You know. And I think something I wasn't expecting, but I've really grown to like over the years is like the communities. So like I think we'll end up talking about things like Wall Street bets, something I call FinTwit, so like the finance Twitter community, and I get a lot of entertainment from them too. And of course, I get to like learn about the world. Like so, when I was talking about the world being interconnected, right? When you learn about things like, oh, what is the futures market? What are commodities? What does that even mean? Right. So like from the when you were young and you read a textbook about like, oh yeah, people like used to back in the day have a marketplace in which they used to go sell goods, right? What does that look like at the global scale, right? People hear shipping and they're like, oh, you ship goods around. Okay, cool. Well, what is that even? It's not like I understand a lot about it, but I understand something. And it becomes cool. And it's like I said, it's entertaining. So a lot of my, I think, interactions with the financial markets, they almost feel like edutainment. So it's education plus like entertainment. And then of course, I think the last thing that attracts me to this field is the money making part. You make some money. You lose money too, but you make some money. So uh, yeah, I think that's pretty fun. I think what would be really good is like maybe if we go a little bit into like just some basic things I think about the stock market.
Sure.
It might be fun to kind of talk about those things because I think it'll really anchor some of the next pieces we want to talk about.
Yeah, I was going to ask you, how educated were you in your first, investment when you lost 30%? Like, what had you already educated yourself with? Were you talking to people? Were you looking at YouTube before you pressed the buy button on that first trade? What were you doing?
Yeah, I've always been somebody who looks at something and be like, the best way to learn about it is to dive head first, right? And that's what I did. And so my extent was like, cool, how do I open up an account, right? And let me just buy the name of some oil companies that aren't doing well right now, but they should do well in time, right? Because they have so much. And so I just read a bunch of articles. I'm like, these guys are doing good, so let me buy it. But like even simple things, like I'm trying to remember at the time, but I probably didn't. It's like simple things about knowing like stock price versus like market cap, you know? Like
You're a
what
freshman?
I think, no, I was not a freshman. This was around 2014. So I was probably like close to a senior in college.
So that's why you have this money saved up from your college gigs, basically.
Yeah, college gigs and like doing research,
Okay.
and I was always a very very frugal person. So,
Was
but
fast case?
uh yeah, I would say I'm less frugal than I was before. Definitely.
Okay.
I mean, college, we're talking about like, you got the Taco Bell on campus,
Right.
and this is when they had like the 89 cents cheese and bean burritos before like the prices egregiously rose to $1.09. Like, I don't understand that. That hurts me,
Right.
But I was like, dude, you got this bean and cheese burrito. You tell me I can have a whole meal for 89 cents. I'm good to go. Um,
Gotcha.
so, yeah, like I remember even then, like, starting to get involved with a little bit of stocks and just buying some stuff. And there were other friends in college who were buying some stuff too. Like, even to this day, I have some friends who like will want to start getting into it and they'll be like, oh, but taking like Tesla as an example, like Tesla stock is like now sitting at $1,500, or like Amazon sitting at $2,000, or like that's so expensive. Let me rather buy this stock that's sitting at like $89, right? And that can rise to $2,000. So I think a simple thing of misunderstanding what's happening there can really like affect people because they're like, oh yeah, everything's the same, right? But like stock price is not the same thing as market cap. And so When you
Let's talk
are
about that. Why don't you explain those two terms?
so when you are buying a stock, right, and it says that it's worth $80, what you're doing when you buy a stock is you're actually buying into some equity of the company, right? And by you making a decision of like, hey, I'm going to buy this stock and I want it to go up, what you're trying to make, you're the statement you're trying to make is that I think this company is going to be worth more in the future, right? And so by proxy, the stock price should be worth more. But like people don't quantify that. What does that mean? You know? So like if you're sitting there, for example, looking at Apple's stock, right? And you just look at the numbers, right? So something like Apple stock is worth uh like I think it's like 300 something now, right?
Sure.
Um, but like a few years ago, I think it was worth like 150 or something like that. And you're looking at that and you're going, oh, okay, what does that mean? So the number of like equity pieces out there, which would be the number of shares out there, multiplied by the stock price, will
Mhm.
give you the market capitalization of the company or how much it's worth. So market
Okay.
capitalization means how much it's worth. So for a company like Apple, you would take like those shares, which are worth like 150, you would multiply it by all the number of shares that exist, and you get how much the company's worth. So at that time, I think it was probably like 600 billion, 700 billion, right?
Okay.
So if you're buying a share of Apple and you're like, hey man, I'm buying $10,000 worth of Apple and I'm going to become a millionaire in 10 years, you know? Like that means you think the company is going to be worth 100x more for your
Like
10,000.
trillions.
Yeah. Right. And it's like, does that make sense? You know?
No.
And so it's a simple thing like that. So when people say like, oh, this stock is worth $2,000, but there's another stock that's worth $50, right? So I'm gonna buy the one that's 50 because I think it's gonna go up to 2,000. That's like incorrect because the one you may be buying at 50, maybe the market capitalization of the company for that particular company is already extremely overvalued in your opinion.
Gotcha.
Um, so like
So you're saying what you're telling me is stock price is much more dependent on the number of equity units out there as opposed to the market cap. Because if the market cap could be a billion, but if I have a billion shares, it's each is worth 1 cent, $1, I guess.
yeah,
But if there's only, a million shares, there's 1,000 each.
yeah.
Who decides
And
that?
and I mean, there's you heard about companies doing like stock buybacks and things like that. So when a company does
I don't
like
know what that means.
so there's been a phenomenon where recently a lot of the companies they've been taking the extra cash they have and they say like, hey, the markets are doing so well and we think our company is going to continue to do well. So traditionally companies will take that type of cash and they'll reinvest it in their company to do investments in research or development. They'll be like, hey, I'm going to take this $10 million. I'm going to hire a bunch of engineers to work on this problem because I think that's going to get me more customers in the future. I'm going to have a good business plan. However, the greatest like business technique has been recently like, hey, I'm going to take this $10 million. I'm going to buy shares of my own company from the market because I think those shares are going to go up in the future. But by also
Okay.
doing that, you're removing the number of shares in the market, right? So your
Yeah.
earnings per share go up and all of these things. So your everything like looks nice on a like stats perspective. So just when we're talking about like the number of shares, right? There's also like a perspective of the number of shares that exists. It's not necessarily all the number of shares on the market and all of these things. Um, so like these are all things that like affect the stock price. So if you have a lot of demand, but you take a lot of the demand, if you have a lot of demand for a stock, right, but you take the number of shares off the market, then it helps drive up the price. But then what are you going to
Okay.
do with it? Like as a company, are you going to sell it back to the market at one point? Like how are you going to make money off of this? And if you do, does that demand exist? Does it not? All of these things.
That doesn't make a lot of sense to me. That's like if you bet on your own horse instead of the best horse, and instead of actually feeding your own horse or like investing into making your horse faster, you're like, my horse is, I'm so sure it's gonna win. I'm gonna bet on my own horse.
Like a lot of things in the markets, right? Having a diversified approach is good. So it's like those companies, hey, you should invest in R&D and maybe you should do some stock buybacks. The thing is, it's like too much of a good thing. right? They're like, hey, let's just all keep doing it. Let's just all keep doing it. So you and I, like, we know companies too where they've done like large stock
Right.
buybacks, and we're like, but you know, so like, uh, that's probably like I think one of the like very basic things though I did want to like kind of impress upon people is just like simple things of when you buy a stock price, right? Can you formulate that when you buy a stock? Can you formulate that more into like a thesis, right?
Gotcha.
So you're like, hey, this company is going to do well in the future. Well, how well? Do you like what are you trying to say? You know, are you like, hey, I'm buying this stock because I think that company is gonna have like 10x the amount of customers, and I think roughly they're gonna have like 30% of the market share. So that evaluates into this. So you're grounded in something. So when
Gotcha.
things move up and down, you can at least have some perspective on that, right? You're not like, oh, the stock doubled. Oh, cool, I'm doing great. Well, are you, or have you very much overshot your hypothesis? Right. So, like,
Gotcha.
I think one of the examples I can use that has done extremely well for me is a stock called Shopify. So I bought that a long time ago, and you've probably heard me talk about it because it's like, oh, it's one of my greatest, right? Like I really like it. Um, but I'm really like struggling right now because right now they have pretty much exceeded the valuation that I thought they would get to in a few years.
Okay.
And so it's like, hey, cool. Is this something that I go ahead and like cash out? You
Right.
know, but that's like a question I can ask myself rather than being like a, hey, let's let it keep riding. You know, let's just ride it all the way to the top.
So when you do a trade on stocks, you look at the market cap for the company. Let's say it's X. You then come up with your own hypothesis for, I think eventually this is going to be 3X.
Yes.
And when it's 3X, hoping that the number of stocks stay the same, the stock will also be 3X. But if not, it'll be close. And then
Yeah.
I'm going to cash out.
Yeah. And there are things that happen all the time. So like companies will sell or create more equity and it'll dilute your ownership.
Right.
Right. So I think one of the greatest examples of this is do you remember this thing? What was it called? I'm trying to remember the name now. I think they were called Movie Pass.
Oh, yeah. HMNY.
HMNY was the parent company that created MoviePass, and boy, were these guys diluting every few months to get some more money.
So can you tell me in your lingo, like quickly, what is their story? I think this is interesting.
Um, so I don't remember that much about the story. I just remember like, yeah, these guys they came up with a plan of like, hey, let's create this thing called MoviePass, and they got a bunch of subscribers, and they started releasing numbers, and people are like, oh, this can be the Netflix of movies. And
Gotcha.
so this thing literally went parabolic, right? But there were so many people out there who like did the math and they're like, there's no way that these guys are going to have a sustainable business model. And you know, maybe it would have been fine. I think this is one of those things that I don't think I have much expertise to say, but like business strategy wise, maybe it would have been better if this was like a private company. Cuz then you can't
Okay.
you can't like scrutinize the financials as much. You can't be like, "Oh man, you're losing this much money, but you're growing this much." Right? Like what are you going to do?
Like Uber before
Yeah.
IPO, I suppose.
Yeah. Um so yeah, it was one of those things that I pretty much like mostly stayed away from. I think I did like some short trades on very short horizons for them. But
Okay.
for the most part, I would say a lot of my trades kind of strayed away from stocks like that because I didn't understand them.
So the short is an opposite, right? Like if I remember correctly, what you've taught me in the past, a short is you saying this company is worth X in terms of their market cap. I think it's going to be worth X by 10.
Yeah. And I think the mechanics of a short are important. So, like when we say, what does it mean to short a stock, right? Yeah, you are very much saying it's going to be worth less in the future. So you're going to make money if it goes down. But what are the specific mechanics? Like, what are you doing when you're
Where's the
shorting
money
stock?
coming from? If the market is kind of losing money and the company is getting worth less, who is paying you money for that?
So when you short a stock, what happens is you actually borrow the stock from somebody else who's like your broker, right?
Okay.
And you pay the broker a certain amount of money to first borrow the stock. And then it will be sold immediately at that point. So like making the example more concrete. Say there's a stock worth $100 right now, right?
Mhm.
And you think that, hey, you know what? I think the company is actually going to be worth way less in the future. Like I think they're a marketing scam or whatever it is, or they're going to bankruptcy soon. I think they're going to fall 50% of their value soon enough,
Okay.
right? Um, so you do that and you short the stock. What happens is at that time you shorted 10 shares of that stock, right? So 10 shares times $100, right? You'll have $1,000. But you've made the agreement because you borrowed the shares that you're going to return the shares at some point.
Okay.
So you have to buy back the shares at the market price in the future.
The person who is loaning it to you.
The person who is loaning it to you demands that the shares be returned at some point. So you have to buy back the shares at some point at the market price. So you've made the
Gotcha.
money of, selling it at the current price. And if the stock
Gotcha.
does go down to like say $50, right? Very simplistic example, ignoring borrowing costs, ignoring all the complicated stuff, but say it goes down to $50 in the future, right? You now made a difference of $500, right?
Gotcha.
And a lot of people, they like shorting because for them and their mindset, like that's much more easy to understand. So like example, we were talking about Hominy, right?
Mhm.
Which is not the way to pronounce it, but it's the easiest way I can think of
I say harmony.
it. Hominy and MovieFast. People saw that trade going parabolic and they're like, nah, no way. I think this is completely based on fluff. I think it's worth nothing. A lot of people shorted that, right? So some people's minds, it just works better. They understand like when a company is totally being hyped and they can understand that. Versus they look at a great company right now, like going back to the example of Apple, if it's already worth, 1.2 trillion, it's like, but can it be worth 1.6? What, like 2 trillion? Does that make sense? Does it not make sense? So I think people have different perspectives. Maybe if you're natural pessimistic, you like shorting. That being
Or maybe
said,
you're just better at
there's
identifying those, right?
huh?
Maybe you're just better at identifying bad business models than identifying great products that are in sleeper companies.
Yeah. That being said, so the risk of shorting is much higher than just buying, right?
What's the risk?
The risk is uncapped or is infinity in the sense like, so if you buy those same shares, right? If you buy 100 shares, if you buy 10 shares of $100, right? Your worst loss is 1,000.
Right.
Now, what happens if you're completely wrong about your hypothesis, right? And the company actually continues to shoot up. So that parabolic move continues, right?
Then you
And
have to pay the difference on all the growth.
yes, so it goes from 100 to say $1,000. So you owe the brokerage firm 900 times 10,
Oh my God.
right? And so that's why there is an idea of like, hey, if you buy and you hold, you're fine, but if you short, you have to realize that your loss is unlimited and you could end up owing your house and you could walk away with nothing.
And that happens.
And that happens. There's a story that I'm having a hard time recalling the story exactly, but
Faizan,
there's
is this the entertainment part of it?
this is the entertainment part of it. But there's a story of like this one guy who used to trade pharmaceuticals, and like I never trade pharmaceutical companies because pharmaceutical companies are like, well, okay, like anything else, the biggest reason is one, I don't understand the industry at all. Like
Right.
I understand absolutely nothing about it. Two is so much is dependent on like drug trials going well or like this not going well, and or maybe a trial does go well and things shoot up or they shoot down or whatever, right? So I'm sure you've heard of this name, but Martin Shkreli, I think is his name. He's the guy that did the
Mhm.
exploitation of the pharma prices or things like that. So there's a story of a guy out there who was short one of these companies, uh, and like the stock price was very small, right? So like he's like, hey man, if it's going down, I'm making a little bit of money, but there's no way this company's market cap, there's no way this company's gonna be worth more overnight, right? And then Martin Shkreli like made an announcement. It's like, hey, you know what? I'm raising the price of this drug to like $600 or something like that. It was something insane that he did.
$6,000. So thousands of dollars or something.
And so like that stock price shot up like crazy. So the story is that the guy is like totally fine with a short position. He goes into a work meeting, right? Once again, amateur investor just like me, goes into a work meeting. He comes out of the work meeting, and at the end of the work meeting, he looks and he owes his broker $157,000, which was way larger than any of the money he had in his account, right? So it's just like shorting is a very dangerous game, and personally, like I don't short just because
Okay.
I think I don't think my brain is well suited for that. Is one, and two, like there's a lot of other things I just don't take on that risk factor, so I don't short. I
I
think
guess when you're shorting, you're making a bigger claim, right, than when you're buying stocks. You're saying, I know better than the rest of the market, than the people running this company, than the investor of this company. I know better than all of them, and I'm going to say this is going to go down.
Yeah, but the thing is, sometimes a lot of people do that. So, right, for example, Tesla is like one of those companies that has been well shorted. Everyone's out there saying like, "Hey, you put all of these companies together, you put Ford together, you put GM together, Tesla's worth than all of these things." Nah, right? So there's all these people that have been like shorting for a long time. Um, I mentioned earlier when you short, right, you have to pay borrowing costs too. So it's apart from
Right.
just so when a lot of people are shorting a stock, the short interest on that stock goes up. So the cost of shorting goes up. If everyone wants to short this thing, well, you better be sure, right? Because everyone's doing the same thing. So
Gotcha.
it's like, and so Hominy was one of those examples as well, where the short interest was insanely high.
Because everybody was shorting it.
Yeah. And now when everyone's shorting it, there's an idea of like, man, there's so many shares that are out there that are shorted. These people need to buy back the stock at some point, right? And sometimes you get an idea of what's called a short squeeze.
Okay.
And what a short squeeze i- is like, say the average trading volume of the stock is like 1 million shares, right?
Per day.
Per day, right?
Sure.
But say 10 million shares of the short stock are shorted. So it's like
Okay.
it's like a stock that has like, you know, very low volume of trading, but much of it is shorted. Now, what happens if that company actually does well, right? And like you say, you're that guy that shorted at $100, and now suddenly the stock shoots up 20%. It's like sitting at $120. You're like, shoot, I think I want to cap my loss right now. I'm trying to get out, right? That's you.
Okay.
You're
Okay.
like, I'm cool. I'm just gonna walk away, and but then everyone starts thinking that, right? And if everyone starts thinking that, what are you doing when you say that you're limiting your loss? You're buying the shares back, right? So now you've
Mhm.
created some buy volume. And if
That's
there's
right.
10 million shares that are now trying to buy back, guess what's going to happen to the stock price? It's going to go up even further. So
Oh my
these
God.
people who had a negative hypothesis about the company actually end up driving up the price of the stock just by trying to exit at the same time.
That's so stupid, dude.
Like I said, it's very interesting, and like it's a fun game, especially when I look at it from the sidelines because I don't short, right? And I
The
go,
way you
ooh.
the way you describe it, what the individual is doing sounds fairly understandable. But what ends up happening at the market level is anyone's guess.
Yeah, yes. And I think we can talk more about this later, but like a lot of, for example, me as somebody who's an amateur investor, I'm not a day trader. I'm not out there, reading and waking up exactly at 5:30, getting my thoughts together by, 30 minutes in, 6 to 6:30, preparing my game plan, 6:30 market open, and I'm out there buying and selling. I'm not a professional day trader or anything by that. And so a lot of my time is spent just like literally looking at these communities like FinTwit or all these guys and just understanding like what is the sentiment out there. And
Let's
like
talk about that.
me, and
Let's
I'll
talk about the
maybe like
communities.
make a few trades. Huh?
Let's talk about the communities.
Yeah, so I think one of the very fun ones that's cool to talk about is Wall Street Bets. Okay, this is a subreddit on, and I'm assuming everyone knows what Reddit is. So this is a subreddit, and I discovered this like a few years ago. And honestly, I found it when I was looking at other subreddits for investing. So like there's a subreddit called /investing/stocks, and I found these Wall Street Bets guys. And I'm like, they said some things that made sense to me. It's like honestly, they're speaking their own language. That's what it is most of the time. But what I found was that once I got past the language, right, these guys were out there. All right, they were throwing the craziest things out there. But for me, it was all like, oh, these are ideas, and it's something. Even if it's a stupid idea, it's something, and I can see where things are. A lot of how ideas are expressed or how experiences are expressed also are through memes. So it has a great collection of memes. Wall Street Bets. You think everyone's about making money, right? But like they look at losing money as like wearing like a badge of honor. And so like the more money you lose, the cooler you are, and the better of a meme you can make about it. Oh my gosh, you're so popular.
So there is some saving grace. Like you lost your livelihood, but a bunch of people on the internet think you're cool.
Yeah, of course. And the internet points are what really matter. There's
Do you post? Do you post on the subreddit? Do you post?
I do not. I do not. I am a lurker. Just look and I enjoy the stuff all day.
Have you actually gotten stock quotes from there that have helped you, or it's mostly on the entertainment side?
I think while I haven't like specifically traded on anything there, it has always helped me a little bit understand sentiment of what's going on. Like it's a very good proxy for me to understand retail trader investments. So like when I say retail traders, so you have your big guys, your institutional investors. That's what they're called. So those are the
Berkshire Hathaway, like
Yeah.
the big ones.
big guys, the big banks. Those are the institutional investor, and they drive the price on everything. It's like some these institutional investors. They represent big banks. They represent the big rich guys, and like I think there's like some quote or something out there where it's like an NYU professor like did a study or something like that, and it's like
Mhm.
80. It's like 80 to 90% of all stocks are like owned by the top 20% or top 10%.
I mean, that makes sense in terms of ownership in general. That's
Yeah.
just generally you have the 99-1 rule, right? Like 90% of people are in one bracket, then 9, and then 1. Like it's very logarithmic.
Yeah. So, whenever these guys buy into a stock, it like usually shoots up the price and everyone's buying in, right? But there's these retail investors, these amateur investors. That would be like people like me, just on our own, doing our own thing. So this subreddit of Wall Street Bets, these guys are a bunch of retail investors. And it's good to see their perspective on things and what's going on. I think one thing that's been very interesting recently with COVID, and I don't know how much I want to talk about at this point, but like there's this whole thing happening in the community of like, man, can retail investors actually drive the market? Because it's always like retail investors don't drive the market. But there's all these like meme stocks and all these things that would be described, and they're just like shooting up like crazy. And all the reckless behavior of these guys is actually affecting the market.
Oh, really?
Yeah. So I think it's been very fascinating. I think if I went into those details, I'd probably have to explain more about like market mechanics and things like that.
How many people on Wall Street Bets are like you in the sense that they don't have a degree in finance, they don't do it for their own professional life, but they know a lot about it versus actual traders who are just hanging out there?
Oh, dude, mostly everyone. I would be very surprised if there's like, and I think there have been occasional posts where somebody will post something and you can see they understand way more. They understand all the little things going on, and those posts are very few and far between.
Got it.
But like the rise of that community and watching it has been so fascinating. From like nobody knows these guys to like they show up on CNBC. They like everyone's talking about Wall Street Bets.
Really?
Yeah.
This subreddit is mentioned on financial news.
Yeah. Like and I think one person said, "Hey, you want to know where the wild traders of the '90s went?" Go look at Wall Street Bets, right? I don't think it's like an exactly fair claim, but like I see what they're saying. Like, so for example, let me story time. Let's go into one of these stories. I call this the story of Guh. Okay?
Okay.
And I'm sure people on Reddit, like they might have seen something about it when it was happening. So this was like I said, you celebrate the idea of losing money, right? So there was a guy who posted a video of himself and he's waiting for like the market to close and Apple earnings to come out. Okay. And he's
Okay.
bought, I don't remember if he bought a bunch of calls or puts.
You will have to explain what those are.
So I'll explain, but they're a leveraged way to
It's another way of messing with the market, let's say. Sure.
yeah, and I'll definitely explain afterwards.
Okay.
But with the Guh, where it comes is like he's watching this video, right? And he sees his position. His position is like I think like a few $1,000s or something like
Okay.
that,
Okay.
right? And he waits and waits, and then the market closes, and you know how they release the news on there, and then there's all these algos that like pick up it immediately, and they find out if the earnings are positive or negative and all this stuff.
Okay.
So they do that, and you see his position literally go from like in the green to extremely in the negative, like right in front of him, and it becomes like negative some tens of thousands of dollars.
Oh
And
my
like you see his
God.
face because he's recording his face, and he literally goes, "Guh." That's the only sound he makes. That's the only sound he makes. Okay. And you know what? This by itself, by the way, this video by itself, very entertaining. Great Wall Street Bets post. Oh, amazing. Okay.
Oh my God.
But there was this another layer in there, which was like either I don't remember if he explained or if somebody asked. It was like a, hey, how did you trade this? Right. So now, before I jump into the second half of the story, I'll explain what options are. So
Okay.
it's like a little intermission.
Okay. Okay.
So options are some people talk of them as like looking at them as like almost insurance contracts or things like that. But essentially they can be seen as contracts to see whether you have the right to buy the stock at a particular price. So
Okay.
when you usually buy something like a call, right, is you have an idea that you think the stock is going to go up in the future, and a
Okay.
put is that you think the stock is going to go down in the future. So a
Okay.
call is the right for you to buy shares of a stock at a certain price. A put is the right for you to sell shares of a stock at a certain price.
Gotcha.
So if you think, sticking with $100 because we've been so good with the $100 stock.
Yeah. Yeah.
If you think that stock is gonna go up to $150, you could buy it outright, right? Like what we were talking about, right?
Mhm.
But if you want to leverage your position and you want to have the option to buy, but not necessarily buy, you could
Mhm.
buy a call option, which is the right for you to buy shares of that company at $100, but you don't necessarily
Okay.
have to, right?
Oh, so it's not like a short. Like you don't have.
Yeah, you don't have to.
Okay.
So when you and I'll explain a little bit of the pricing and stuff too, because I think it might be interesting to know. There are these things called strike prices. These are the exercise prices, right? So if a stock is worth $100, right, and you're trying to buy a call option of 101 or something,
Okay.
that would be called a strike price of $101, right? And if you
Okay.
do it $120, $120 is the price.
Okay.
Now, to be clear, if the price only goes to 119 and you bought it for 120, that call option is worthless. Whereas
Oh.
if you had just bought the underlying stock and it went to
Right.
119, you still have the money.
Yep.
And usually how the pricing works is if it says like, oh, it's $1 for this for this contract, right? It's actually the number of shares in that contract multiplied by the price. So usually the number of shares in a contract is 100.
Okay.
So if it says $1, you multiply that by $100, right? And you get the chance to buy 100 shares of that stock at that price.
Gotcha.
Because I just said the price of is $1 times 100, right? You're saying is that essentially the option itself has some value. So what
Right.
people do is they just trade options. And
Oh,
because of how the markets work, usually they very much at the end up representing exactly that price difference. So
okay.
if the stock is worth $120 and you bought it for a call option of 100, then usually your option is now worth $20. But
Gotcha.
$20 times what? 100 shares.
Gotcha. Right. Because you have 100 shares in the option. Even though
Yes.
it's a single entity,
Yes.
it's like a container for stocks. Differences,
Yes.
in fact.
Yes. So
Okay.
if you had bought that call option for $100, right, and you paid $1 for each, and now it's only worth $100 for you to buy it, you actually made 100 times 20,
Yep.
right? And that's way more like leverage than if you had just went out and bought one share for $100, where you would have only made $20.
So basically, you spend $100.
Yeah.
But that's your max loss now as well, because ultimately, potentially, you just don't use the option.
Yeah. It
But
just
the
expires
gain,
worthless.
yeah, but the gain could be as much as the stock goes up if
Yeah.
you end up hitting the strike price, at least.
Yeah. Yes. Yes. And so puts are a way of looking at insurance in the sense that you may own a stock, right? But you could actually, so like the right, I don't know if the right is the way to describe it. The safer, more traditional way to use put options are, say you own 100 shares of Facebook, but you don't know what's going on with all the scandals and all this stuff, and you're like, hey man, or maybe the market's not doing well. You're like, you know what? I'm very scared about what's going to happen in the future, but I don't necessarily want to sell all my shares because I think the company will do well at some point.
Okay.
Do you want to stomach the loss, or maybe you're like, hey, in case I need the money, I want to just limit my downside? Then you can buy put options, right?
Okay.
Which will give you the contract ability to be able to sell your shares at a certain price. So
Okay.
if you bought put options at $100, you can sell your shares at $100. Even if the price goes down to like $50, you can sell it at $100.
But who is
Okay.
buying it?
It's the other person who sold the contract.
Okay.
So
But they might end up selling a contract to somebody else for some price, and then they to somebody else. So ultimately, the person you made the contract with might not be the person you're actually selling the stocks to, right?
I don't know much about the transitive property if you've sold it. I don't think you can like keep doing that. I think one contract is one contract. You can write more contracts.
Oh.
You can always write more contracts, but it's not like that same contract is like.
Gotcha. Okay.
But I mean, hey, there's so many ways to layer financial products. I think that's one thing I've learned through the years. So many ways to layer financial products. These guys up the chain are playing like the craziest games they want to play. Okay.
Okay.
But yes, with that, there's an idea of, so I explained the idea of a call, right?
Yep.
You can do that. So you can buy a put, you want to save your stocks, right? Similarly, there's going deeper into the option thing, there's an idea of a covered call.
Okay.
So you know what I said, like somebody buys the call, they have a chance to buy 100 shares, right?
Mhm.
Well, who are you buying the 100 shares from, right? There's
Right.
somebody out there who has actually 100 shares of the stock, and
Right.
they've written, what they've done is they've created something called a covered call, which is that, hey, on the market, I can sell the option to somebody else for them to buy my shares at this strike price. And usually what that has to do with is like, you think the company's going to do well, that's why you have the shares, but you don't think they're going to do that well. You know?
I see. I see.
So at the same time, why don't you make some money off of that? Sell a covered call, right?
Gotcha.
Yeah. And with that, I can explain the GA phenomena. So the GA
Okay.
phenomenon has to do with these guys figuring out exploit in Robinhood. What you'll find, by the way, is all of these guys use Robinhood. That's something we can definitely talk about a little bit later. But Robinhood has definitely made it easier to trade stocks, and some people would say it has gamified it. So,
Okay.
but what would happen is essentially like a person who has Robinhood, and there's different like memberships in Robinhood. So there's one called Robinhood Gold, in which you can trade on margin, you can do all this stuff. You're selling a covered call. So you have actually some shares, right?
Mhm.
But you've also bought those shares using money borrowed from Robinhood. Now, this is normal. Like, there's nothing weird about that part. But what happens is when you sell the covered calls, there's a mistake in that Robinhood actually would add the value of that back to your account. And then
Okay.
what happens is that you could borrow more money, buy more of the stock, and sell another covered call.
And
And
that gives you more value back.
yes. And like here's what a responsible person would call that. Responsible person would call that, oh, that seems like a fault, or that seems like a bug, or something needs to be fixed.
Mhm.
To give you an insight into Wall Street bets, you know what they called it? They called it the infinite money cheat code. And some of these guys, it was great.
It's actually a game in people's heads.
Yeah, and it was great because some of these guys, they were literally like trolling other brokerages and being like, "Oh, so you guys offer this and that, but do you offer infinite money leverage like Robinhood?" And so, like I said, what I said with that guy's video with him doing the "guh," right? Like that was great enough, but people like were like, "Oh wait, you did this method?" And just like the irresponsible degenerates that exist on that sub, which I think are amazing, they started using it to full content. And it's not like this guy who was just tens of thousands levered. No. There was like let's see, I think I have a chart here somewhere. Yeah, like so some of these charts, like I think looking I can only find like one example right now, really looking up, but I think it was like they deposit like one guy deposited like something like $10,000, right? And he leveraged all the way up to like several $100,000. There
Oh
was
my
one guy, and I'm
God.
looking at this guy right now. This is the one I looked up. He deposited $15,000, and just using that same method, he leveraged up to $1.3 million.
Oh my god. That's like if I walked into a bank and I said I need a loan of $1.3 million and only thing I can put up is 15,000.
Yeah.
That's all I can do.
Yeah.
No bank would ever okay that loan.
Nah, but this infinite money cheat code, and so like
How does Robinhood, okay, if I'm Robinhood, after this happens, I am employing somebody who is dedicated to at least taking a look at Wall Street bets every day, just to make sure things are okay.
I mean, maybe they do. Maybe they do. I don't know if they do for sure. I think, I mean, Robinhood, I think, is making too much money to even have these things like so negatively affect them. Because in the end, like I think it was like a handful of people were actually able to do this in a short period of time, and then Robinhood did like patch it, right?
So it's gone now. The cheat is gone.
Yeah. Cheat is gone. It was gone relatively quick. But like the fact that these guys are just on there going, "Let's go, man, let's do it," and yeah, it was.
And this is what the Gurdu did too.
Yeah, this is what the guy did too. But like, his loss was capped at like the negative whatever 50,000, whatever,
Jesus.
how much money he lost. But those people who leverage up to a large amount, I think they lost even more.
Okay.
And
Did they have to pay it back to Robinhood or what happened?
I don't know. I think all of these are settled kind of individually in like court, probably.
Oh, wow.
Because I mean, I heard somebody like say like, oh, you know what you could do? You blame Robinhood because they created the system that lets you do this. So I saw things like that. I don't know anything about that. Like I said, I'm on the sidelines just enjoying the entertainment.
Yeah, I don't buy that logic. That's like saying, "Oh, you left a hole in your firewall, so I hacked you." Like, what?
But the amount of memes and the great things that came from this is amazing.
So this must be like a legendary story on Wall Street bets, right?
Oh yeah, the story of Guy is definitely there. There's other legendary stories. I think maybe this would be a fun one to talk about. Is the story of Irony Man? That's the name of it. Irony Man.
Oh, Irony Man. Okay.
Yeah, like he has a lot of irony. So there's a guy, he posted about like I think he posted one day about like a great strategy to make risk-free money. That's what I say, risk-free money. And like the way he came out on that post, because I remember I read the original post. I was like, oh man, this guy sounds smart. That's what I remember saying. Yeah, I'm like, he sounds smart. Like he guaranteed money by doing like it was an option strategy called a box spread. Um, so you know how I said you can buy calls, whatever. So you can buy calls, you can sell calls, and you can imagine that if you buy calls and you sell calls at a certain point, you can like limit your upside risk, right?
Right.
Same thing with buying puts and selling puts. You can limit your downside risk and all of this stuff. Well, you just limit your risk within a band either way. But a box spread is basically where you sell a call, buy a call, and you buy a put, sell a put, right?
Okay.
And he basically said like, hey, this strategy, no matter what happens, whichever way the price moves, right? You're gonna make money. Like it's a inefficiency in the options market. And so by I think he had only put in like a several $1,000s himself. But once again, through Robinhood's not so great systems as of this point, um, he was able to basically do all of that and get about like $300,000 in Robinhood credit. But
Oh my God.
when those options would be exercised, he said like, "Hey, look, a year from now, I don't remember what the time horizon was. It was a year or something. It was out in the future." He's like, "When all of these get exercised, no matter what happens in the price, the max I'll have to ever pay anyone is 250,000. So
Okay.
it's a guaranteed way to make like as like he had to pay 250 something thousand. So it's like, oh, it's a guaranteed way to make risk free like 40,000. I put in $5,000, so it's a great way for you to make $37,000, something like that,
Wow.
risk free. And it's like everyone can do this, and everyone's like looking at that poster like, oh man, that's amazing. That sounds so cool. Like I remember like people commenting, be like, wow, this is so cool, right? And then like a few days later or something like that, there's a post and it's the same guy, and it shows his Robinhood account balance, and it's a negative $57,000. And so what had happened was
Oh, wow.
once again it's like it's very much like punching above your weight,
Okay.
but the risk here is very real in the sense that it's a lot of money. What are you doing? These are like real financial instruments at some point. You have to be careful. And so what he had done is he just like, oh, his model held great for when the options are exercised. He said a year or two from now, right? But there's a simple like mechanic that he missed. And it's the idea that somebody can exercise their options early. They don't have to wait till the very end,
Right.
right? And so somebody had done that. Like I said, he had sold a call, he had bought a call, he had sold a call, he had bought a put, sold a put, right?
So
So
other
one
person exercise them.
so there was one of those trades, at least one or two of those trades where he had like sold that, where the other person on the side of the trade is doing something like, wait, you're telling me that you want to sell it at this price, but I know for sure in the future it's going to be way above. I want this in writing. Assign the option to me now. And so they don't see irony, man, right? They just see this trade on the market. They see this option contract on the market, and they're like, cool. And Robin's like, all right, I guess we got to assign that. Goes to Irony Man, says, Irony Man, do you have the shares? Irony Man's like, what shares? And they're like, all right, let's close this trade. All right. And we're
Okay.
going to assign you either these shares or the amount of money you owe. Okay. Oh, you don't have that? We got a margin call. We got to close your other trades as well. And all of those trades. So the whole like option strategy all like collapsed because everything was exercised essentially at once. One thing was exercised, and Robinhood's like, we're going to close out all the other ones. So instead of him having that nice time horizon, he could exercise whatever. It completely blew it up because this one's exercised at this point, and this other options was completely like Robinhood just closed it out. So instead of risk-free money, he ends up owing $57,000.
The one problem with his plan was he didn't realize that there are other people who can act before that deadline.
Yes.
And then the cascade. One
Yes.
One option being exercised made all the other ones being exercised.
Because it triggered a margin call in his account. And so I don't know if people know what a margin call is, but it's essentially the idea of like say you've borrowed $100,000 from somebody to go like buy all these stocks and everything,
Mm-hmm.
right? That's cool, but what happens is these stocks represent the value of their borrowed money, right? So the 100,000 you've bought it. Now, if you don't have any money in your account, say you don't have 100,000, you only have 10,000.
Mm-hmm.
So you're levered up. You're levered
Yep.
up to 100K versus like your 10K. People aren't dumb. The brokers look at that account and they go, "Okay, what did he do? Huh, the price of that is going down. There's a chance I could lose my money here. Hey, I'm going to do a margin call. I'm going to ask that you deposit more money in your account to show me you're either good for it, to show me that you're good for it. And if you don't have the money, they're like, hey, we're going to limit our risk and we're going to close out your positions."
Gotcha. Any brokerage has the right to just do that to their customers.
Yes. Yes.
Gotcha.
So, I mean, that's what happened to them. I think it might be also good to explain the difference between like brokerages and exchanges. So, like, I think people might not know that.
Yeah, I don't know the difference.
So, for example, NYSE, that's a New York Stock Exchange, right?
Yep.
An exchange is a marketplace. So that would be like your local market, like coming together and be like, hey, you want to sell 10 apples, you want to buy 10 apples, like they facilitate all that, right?
Mm-hmm.
And you can actually trade with an exchange directly if you have the money. If you have the money, you can plug in directly with the exchange. I don't know how much the seats are. I think like I have no idea, but I remember reading something a while ago. It's like, oh, back in the day, like New York Stock Exchange used to cost like 50 grand for like a seat or something like that. You plug in directly with the exchange. For most retail amateur people like us, nah, that's not practical, you know?
Right.
So what do? We go to a brokerage. Somebody like E-Trade, somebody like Robinhood, who are customers of all the exchanges. So not just New York Stock Exchange, they'll be customers of many exchanges where these marketplaces happen. A lot of like straight institutional investors, like people who are like banks or something like that, they usually are hooked in directly. You know, other investors, they'll use a very high powered brokerage to handle these kind of things. But I think all that to be said is like that's kind of like the fundamental ideas of like how markets function is, right? Like on an exchange, you have an order book. They have people selling, you have people buying. So people who are like professional traders, they look at this order book, you know, they see order flow like really happening on the buy side. They're like, oh, they trade based on technical signals and all of these things. What I think what would be really cool to understand is like what are the different types of like professional investors out there. So I think most people that we know, like they understand the basic ideas of like HFTs, right? Like high frequency trading firms.
That's when algorithms and like computers are trading in like milliseconds.
Yes. And you know, what are they doing? I think everyone understands the basic idea of like, oh, they're able to see pricing discrepancies faster than other people in the market, right?
Mm-hmm.
So they're plugged into these exchanges, right?
They paid the $50,000.
Yeah, they pay it because they know they're going to make way more.
Gotcha.
And to be fair, a lot of like these other people that are big institutional heavy investors, they're in there too because they don't want a brokerage, right? A brokerage is a service. It's a business that's offering you. It's a business that's offering you a service, right?
It's like a marketplace of marketplaces.
Yeah. Yeah. That's a way to think about it. But like when we think about these professional traders, like I think HFTs are a cool example to go into because they kind of show you how exotic, maybe exotic is a word, how exotic some of these things can do and like what it is, right? So HFTs, other hedge funds, what makes somebody a professional trader, right? Like they find some type of edge and they systematically exploit it. So it's not like me over here, like regular Joe Schmo saying like, hey, I think Apple's going to go up, be worth this much in this time. No, they're looking at like things in the market that are either very technical or are there and it's very systematic and they continue to use that and make money. So with HFTs, for example, there's a book that I read a while ago, and it's a great book to read. It's called Flash Boys by Michael Lewis. Great name, I know, but I promise I promise there are no boys that are flashing you because that would be illegal, sir.
Flash
Um,
boys.
and in it he talks about like HFTs and stuff, and he specifically is talking about one institutional investor who, like, I think the story goes basically like he saw something was very weird in his terminal, and that whenever he would go to professionally trade, and he's trading a lot for his institutional investors, these guys out here who call him up, they're like, hey man, I want you to buy me 1 million shares of Microsoft. Okay,
Sure.
go do that for me. But the reason they contract his services is because he goes to the market and says, man, the demand right now is only 100,000, but I want to get the best price for my client.
Mhm.
So, he'll maybe buy 100,000 shares now, and then over time, he'll kind of like artfully work his way in and then buy the rest of the shares to get his client the best price of 1 million shares, right?
Okay.
Yeah.
That makes sense.
Yeah. Like I said, these guys, these big guys, they're plugged into exchanges directly, right? They're not using E-Trade,
Yeah.
right?
Or
They're
Robin
not
Hood.
using Robinhood, right? They're plugged into the exchanges directly. So they'll actually see on New York Stock Exchange, somebody's willing to sell 50,000 shares. On this other exchange, somebody's willing to sell 30,000 shares. Somebody's willing to sell 20,000 shares. And they'll often have like software or something that can allocate and like quickly go execute the trade among all of these markets, right? But the underlying story of it is this guy, he would go and he would place a trade for his clients, and like he's a smart guy. He's been doing this for a while. Okay. So he's looking, he's like, I'm trying to buy the shares at $34 and everything's calm. Like I see it. I see the order flow. I see what's in the markets, right? I see 100,000 shares are available at 34. But as soon as he would click execute to go buy the trade, all the shares would pop up to 34.25, 34.50. And like he'd certainly lose like a bunch of money on that trade, right? Because now he owes his client for that difference.
Right.
Essentially, what it is.
Right.
It's a little more nuanced than that, like exactly how they do it. But what had happened at the time, and like this is when HFTs were really like rising into prominence. So it's not like everyone in the markets knew what was going on. Even these professional guys, they just had an idea of like something weird is going on.
Okay.
And so with HFTs, like I said, different exchanges existed, right? In this particular one, there was an exchange called BATS, and they
Okay.
had put this exchange, they had created it, and it was like right outside the financial district
In New
and
York.
in New York. And like you had to understand so many nuances. Like these guys actually understood how the fiber was laid in New York. And they understood that the New York Stock Exchange had moved all their servers to New Jersey. Right. And I think at that time also it was another part of New York. So even though you had the financial district and maybe you had like the exchange, if it was in New Jersey or at that time, I think maybe it was close to them, it was across the street. They actually understood that even though it's just over here, it's actually going to go through all these miles of like fiber before it reaches here.
Okay.
And they had put the BATS exchange right here, which, I mean, in the book, it's claimed it was created by HFTs. Like they had ones who had financed it. So they could see before the exchange went to New York Stock Exchange or Chicago Exchange or any of these exchanges, they'd get the order first,
Sure.
right? And based on the order, they had actually created, I think it was called latency tables,
Okay.
something like that. And so when they would get the order of like a stock going up, and then they'd look at if that same order was going to another exchange, and by measuring the time differences between those two, they could tell which institutional firm or brokerage was executing that order, and they could take a guess on, yes, this is going to be a huge order, and they would move way faster than everyone, and they would just buy all the shares and then sell it back at
To the
higher price.
to that specific other.
Yeah.
Oh my God, that's
Yeah.
genius.
So it didn't affect any of us Joe Schmoes, right? We're buying
Okay.
like 50 shares, we're buying 100 shares, we're not out there buying millions,
Yeah.
right? So that's one thing in Flash Boys. I think he like very much puts it as like a story of good versus evil, and evil is like these HFT guys. I don't see it as that way. I'm like, look, there's a guy who used to do things one way in the finance world. There's another guy who's doing things in a different way in the finance world. There is very much an idea of though like what HFTs do like can be, because it's like a race to the quickest, right? Like what are you going to cap it? like I think the things he talks about in the books is like essentially they're co-locating, they're putting them directly like within one like data center. So like here's one guy, and then they're measuring the length of the fiber optic cables. There's like a crazy story he has in there where they're like also super secretive. So like I think one of the guys, like one of the firms, they buy a server rack space that belonged to Toys R Us, but like they say, hey, don't. And the Toys R Us had like decorated that cage, so it was decorated with like Toys R Us memorabilia. They're like, hey, don't remove any of that because we don't want them to know they're in there, right? But like this race to the fastest, like where does it stop? You know, and is there some idea of like fairness? Because while we think like institutional investors just represent the big rich guys,
right?
Your retirement funds are handled by an institutional investment. Right?
Oh, okay. So what you're telling me, stepping back, well, so far in the story, my opinion was there's two bullies fighting each other, right? Like I don't care, man. It's a bully either way. But what you're telling me, this is a much worse bully.
Yes, it depends on who's on what side, but yes, it can be. And I think the effects they cause are actually like, I think they have far more reaching effects than just the bullying, right?
Okay.
So I mean, where I personally end up falling on it is I think there needs to probably be something in the market that regulates certain things, because when we start getting into like exchanges and what is happening on these order flows, like me saying that they're becoming exotic is just like a very surface way to describe it. Like what the type of in engagements or like agreements that people enter into it is like, HFTs, like you can do very exotic type of orders. So you know how we have a buy order, we have a sell order.
Right.
You might hear of other orders which are like stop loss orders or limit orders. I know that when you're selling your own RSUs, you might see like a limit order, which is only sell it at this price. Don't sell if it's below this price. Yeah, there's actually like way more exotic types of orders out there.
Really?
And I don't understand any of these things, but like these guys use it to like a T. So for example, they'll like have things like, hey, when my order comes in, you completely front run. So they have that agreement with the exchanges. So this comes in from an HFT, they front run everyone in the line and they get their order in first. They have another one, they'll have exotic ones, which is like front run, but based on a conditional of if there's this many people in line, and if this many people are not in line and they go away suddenly, then don't front run anymore. It's like this insane amount of things, and it's all kickbacks going to one each other, right? Like
are they paying for this? Like, how come these services are only available to these people?
Well, I mean, they can be available to you if you pay the money.
That's the thing, right? Like,
yeah.
Okay. It's pay to play.
It's pay to play. I mean, it's like saying like, in a way, it's like, hey, man, you know what? You can't do any insider trading because this material, this information is not publicly available. Okay, like that totally makes sense. I 100% agree with that. Right? There's also other types of information, like for example, like hedge funds. They'll see how much oil inventory is available by like hiring a helicopter to go fly over like an area and then use a thermal camera to see how many oil barrels of oil are filled, right?
Are you serious?
Yeah, you can do things like that. And then you can make business guesses on like, hey, they actually have this much inventory. So therefore,
and that's publicly available information.
I mean, if you had a satellite and you wanted to do it, why not, right? So
okay,
I mean,
this is where I think the capitalism is really coming into like, I guess I really am understanding what a free market means. This is a free market.
Yeah, and I don't think like I have any 2 cents of a say in this, but like one thing I specifically don't like about how the HFTs and the things, like some of the things they can do, you can do something called spoofing the market. Okay. So I think you being from a technical background, you understand spoofing, right? But let me explain it in the market context. Okay. So what I could do is I could put out 1,000, 1,000,000 requests for like, hey, I want to go buy these shares. You flash it on the market. You flash it long enough that everyone sees that there's this demand.
Okay.
Right? So then what they do is they then also want to pile in because they see a huge demand coming up. So it drives the price up. But by the time anyone's orders or anything come in, you cancel all of your orders. but you've essentially moved the market up.
What that strategy might as well be called psych. Like what?
So like I do think some type of thing is needed where it's like, hey man, if you put in an order, like you can't cancel it within 500 milliseconds.
Sure.
Something simple. Like I'm not saying 10 seconds, 15 seconds, just something simple. Cause like I think things like that at like a higher level, it's like me and you having an opinion on other things. Like while we may not be exactly punching above that, like you can still have an opinion on this. So I'm just a retail investor. But I
Mhm.
personally think for like the health of the markets, I think things like this are better. Um,
There
for
should. I mean,
example,
I'm just gonna say there should be consequences of your actions. Is all.
yeah, I think there's a way to do it. I mean, HFTs, they like, they claim to be providing liquidity to the market in the sense that anyone places a sell order, they'll quickly, ensure that everything's liquid. Like, for example, like, how I was saying, like, there's an idea of ownership, like how many people own different parts of the companies, right? And it was like, oh, 20% owns like some crazy amount of all the companies. Similar to that idea, HFTs actually account for most of the trading volume. So
Because
even
it's so
though
frequent.
Yeah. So even though they themselves don't actually own anything, they'll always end up between a buyer and a seller. And they'll actually execute the trade.
Gotcha.
And so they end up accounting for something insane, like I think like 80 or 90% of all the trading volume out there. So that's insane to think about that somebody who accounts for 80, 90% of trading volume doesn't actually own any of the underlying assets.
Yeah.
Right. And they're able to just kind of like snipe it off. And like, so some people like say like, hey, there's a lot of risks to this kind of system. So are you familiar with the flash crash?
Nope.
Flash crash is what it sounds like. It's a crash that happens in a flash.
It's when a boy messes up and causes a flash crash.
So I think like one of the more famous flash crashes is like the one everyone usually quotes is like something that happened in 2010.
Hmm.
And I don't remember exactly how much it was, but I think it was something in the close to like $1 trillion in like market cap disappeared in roughly a few minutes.
What does that mean? Like stock prices fell by that much?
Yes. Well, like overall market value. So like, hey, Apple's market cap fell by like 100 billion. So did this company. So did this company. You add all that together, market value of about $1 trillion just disappeared in like roughly a few minutes. And it
Few
was
minutes.
Yeah, and it was not due to anything. Like it wasn't like coronavirus has popped up, so therefore something's going on. It had been like
Okay.
out of nowhere. Like it would have like Tuesday morning, bam. And so it's like, okay, well, if it was related to something, then it shouldn't have just come back up, right? But it's
Hmm.
a flash crash. So it fell down. And then as markets like started going like, what's going on? In just a few minutes it went back up to like
Okay.
where it was. And people often blame high frequency trading for that. And so like I think there was one guy who was like, yeah, there was one guy that I know of that was like arrested for it. I don't know the full story if he was the only person or not. But what had happened was he had created a program. It was like a trader in London. He had created a program to like spoof the markets and drive prices down.
Okay.
And he had executed a crazy amount of those orders. And then other HFT algos picked up on that and they did the same thing.
It was a cascade of basically
Yeah.
driving the value down.
Yeah. Yeah. The only flash crash that I was like, I mean, I think there was another like mini flash crash in like 2015 or 2016. I don't remember much about that one. But this is the big one everyone talks about. So it's like, there are like maybe some consequences to this because things are happening way quicker than you can do, right? So
Are there any limits on what you can flash or spoof?
I don't know.
Okay.
Yeah. So I I don't know if we want to talk about cryptocurrencies, but like I remember the Ethereum flash crash of 2017. And that one was very interesting because it happened on like one exchange. I mean, I think the flash crash also like the one in 2010 only happened on like New York Stock Exchange or something. But the one in Ethereum was very interesting and that's why cryptocurrency is very interesting as a whole, is because they also have a market there, right?
Yeah.
But the products aren't as layered. So like all the stuff that you hear about, like, oh, this is a common like trading technique or something, they're way more apparent in the cryptocurrency markets. So like the
Okay.
flash crash of 2017 in Ethereum is like very well understood. There was like a
Okay.
huge whale that wanted to sell a lot. So he
Okay.
like put up this huge sell wall or something like
Okay.
that, right? That drove the price lower. And I think
Right.
GDAX was the exchange. That drove the price lower. And what happened was, as the price became lower, people's stop losses were triggered. But
Okay.
everyone was trading on margin. So when their stop losses were triggered, and then it cascaded more selling, and
Okay.
then you had all these people on margin. And so when their things started, like when their price of the asset started decreasing, GDAX was like, hey, margin calling everyone's accounts.
Right.
But people didn't have the money, so then they sold more, which then triggered more stop losses, which then
Gotcha.
triggered more margin calls. So within like it's a crazy like 17-second GIF that I could like send to you, where they actually show the market and they show the huge sell order come, and you see the cliff just fall.
Oh my God. And in those
And then
17
you see it, and
seconds,
then you see it come back up. So the price went all the way from $300 of Ethereum to 10 cents, and then it came back up.
what?
Yeah.
So in that second, were the people able to buy at that price?
So you would not have been able to react to it.
Okay.
And this is what also happened in the flash crash in the real stock market, was
Mhm.
that it happened so quickly. You got to realize all these algos are also pumping in orders, right? There's no
Right.
way for a human to go in there and press order and actually have his order be executed. Like the order book is already piled up. And so that happened
Gotcha.
in the New York Stock Exchange. Like it was insanely piled up. Like it stopped functioning for a few minutes.
Okay. Okay.
So with Ethereum, like you couldn't have placed an order. But now this is where the twist comes in. There were people who had orders sitting at the bottom of the book that were just like, you know how I said limit buy, like limit
Yeah. Yeah.
orders?
Yeah.
Somebody just had limit orders sitting there. And there
For
was
no
actually
reason.
I mean, I don't know who the buyer was, so I can't answer anyone
Uh-huh.
about that. But there were people who were able to buy a few hundred shares or 300 Ethereums like at that price.
Oh my God.
And as far as I know, they became insanely rich overnight. That's what the stories say. I don't remember when I was active in these communities anyone like saying about like, oh, this is the person that made the money.
Okay.
You know?
So I mean, there definitely needs to be regulation, because if you are able to purposefully cause a flash crash and you knew that and you had a limit buy order sitting just for that reason, you could make a lot of money from that.
You could. I think one thing that's very tricky though is when you do a flash crash, you're bound to break systems. And so what you're risking is that all your other assets won't lose a bunch of money while you, one, break the system. Two, you are hoping that your orders that are sitting there will actually execute the way they're supposed to. But the system is
Gotcha.
broken. So like,
I see.
who knows?
It's like chaos then. It's like causing
It's
chaos.
chaos. And you may end up on top or you may end up losing, you know? So
I have a question now that you mentioned crypto. Should I think of crypto like stocks? What should I give me an example of an asset that you think most closely resembles crypto?
oh, I don't know if I can give a good answer to that.
Anything
Just
that's even 50% the same, because like first of all,
Okay.
it's not like a house. It's not like a house, right? That's clear to us.
Yeah. It's funny because like people say it's value, it's money. So some people would argue that, oh, it's like the Forex market, like the where money is traded.
Like money exchange, foreign exchange.
Yeah. Some people would argue that. Other people would argue that it's much more of a speculative like commodity, whether it means anything or it doesn't mean anything. You know, what if everyone wakes up tomorrow and is like, yo, I don't care about silver. Like silver is not a thing, right? I don't even know if that's possible. I don't think I understand enough about the world to say that. But like, I think crypto ends up falling somewhere in there.
What is your personal take? Because I know you own crypto, but I know you don't own enough crypto for it to be meaningful. in comparison to all of your stock exchanges and trades and everything.
Yeah, I do it more as like I'm interested in where certain platforms are going, because a lot of crypto space has moved away from like, hey, here's a store of value and usable for money. I'm going to use this application to try to create value. And
Okay.
I think Ethereum was trying to do that, so that's why I still own a little bit of Ethereum.
Okay.
I sold all my Bitcoin when all the craziness was happening. I was not able to at all get the peak. I think the peak went all the way to like 19,000. I was not
Yeah.
able to get that. I cashed out way before that. But
I mean,
with
it's still free money.
free. um,
Spoken
but
like a long time trader. It's like free is a funny
Ethereum,
word.
Ethereum is Ethereum is like something like its value proposition is that, hey, we can create smart contracts. So based on smart contracts, you can create other things of value. So and overall it looks at itself as a development platform for
So
other
that sounds
blockchain.
more like a company. That sounds more like a stock. Like you buy Ethereum because you think that Ethereum ecosystem in general is going to provide more value in the future.
Yeah. So and there's people out there who come up with like companies and they do something called ICOs, which is initial coin offerings, which is like,
Right.
you can buy in directly. So that's why some people can look at it as also like a company evaluation thing. I think it speaks a lot to me that I think could probably do something more Ethereum based than like Bitcoin based, because
Right.
I don't trade gold, I don't trade Forex. So I look at Bitcoin and I go, I don't know. Sure, I guess maybe that's a thing. I look at Ethereum and I go like, I guess you're more closely to like, I think it's going to create value, so I'm here holding on to this one.
Gotcha.
Yeah.
I mean, you also you might know my take. It's the same take. Like I don't understand these things. I happen to have bought a little bit of crypto in a few years ago when it wasn't like that expensive. So I don't know. No reason to sell it right now. It wouldn't like give me a bunch of money back or something.
I mean, my like the Bitcoin I bought was after the first crash that happened to Bitcoin back in 2013. It was around the same time I like got into the stock market,
Gotcha.
right? And I think what annoyed me about Bitcoin was like I always liked seeing myself as somebody who knew what was going on with the internet, right? So when people were talking this Bitcoin thing, I'm like, why did I look into it? Like I'm doing the stock thing. I should have bought it, right? It's gonna go up. I was that naive guy of like, hey, you buy things, they go up, right? It's great. And so like with the Bitcoin thing, I bought it and I was like, you know what, just forget about it. And so like I was very lucky to buy it at a time when it was super depressed and
Yeah.
like end up doing extremely well. But like I think the second time around when all the craziness was happening, and actually it was pre-craziness, like I saw this Ethereum thing and I was like, yo, Ethereum seems pretty cool.
Yeah.
So I like where they're trying to go with it. So I bought Ethereum, and man, yeah, what happened in 2017? I think you remember the crypto rise,
I do.
right?
I remember
It
that
was
Christmas, that December, when you and I would be looking at charts, like basically every day. Like every day we went into work, we'd be like, "Oh my God, how's Ethereum doing?"
and to give you like a full perspective on that, well, I don't want to say exact numbers. Let me put
Of
it this way:
course.
Ethereum represented less than 1% of my portfolio. It was something insane. Okay, it was very tiny of my portfolio.
Mhm.
At its height in like December or something like that of that 2017 year, Ethereum or not Ethereum, like just all the cryptocurrency, all the stuff represented more than 40% of my portfolio.
Oh my God. And I know somebody who's super smart can just listen to those numbers and figure out all the other numbers, but that by
Well,
itself.
no, because I'm not gonna say exactly how much I bought of anything. I've thought about the equation.
No, but they could know the value of Ethereum.
Yeah. So with that,
That's
like,
insane. Did you sell? Did you sell them or no?
um, like I said, I had sold Bitcoin around that time, so I was able to cash a little bit. But most of
Okay.
my Ethereum, I did not.
Okay, good.
So, I'm just sitting over here with like a loss, looking here like, man, I was such a punk. Like I should have just sold it then, right?
Yeah.
I mean, it still doesn't represent like a loss in the traditional sense of it wasn't like based on my initial
Right,
buy-in.
right, of course.
Um,
I mean, compared to the initial value, we really haven't lost any money or anything. It's more like, lost the opportunity to cash in.
Yeah.
But yeah.
Yeah. Hey man, like, something that's gone up over like 100x in value so I've never had anything that's gone over 100x in value. Okay.
Okay.
Except something I can't even trade because I lost it a long time ago, which
What is
is
it?
freaking Dogecoin. I remember Dogecoin. Dogecoin was something back in like college,
What is
like
the
I
value of
did for
Dogecoin?
fun. Huh?
What is the value of Dogecoin right now? I actually own Dogecoin. I mined some when it originally came out.
So yeah, I mined a bunch just for fun, just to see how it
Yeah.
worked. Like I wanted to have the thing run. I wanted to have the algo run on my computer and stuff. So I did a bunch. But I mean, for the sake of that, I just like, yeah, I don't care what happens with it.
Oh, wow.
Right?
What? 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 Okay, I need to go dig up my Dogecoin wallet with $100 in it.
Hey man, if you actually had $100 of Dogecoin before, first of all, that's a lot of Dogecoin. If you had
Yeah.
that much, okay.
Yeah, I did. Yeah.
Then yes, it would be worth quite a pretty penny right now, sir.
Let me go. I think somewhere in my parents' house, in a trunk somewhere, there's a wallet key for Dogecoin.
Wait, you're telling me you didn't know about this now? All right, I'm gonna take a little finder's fee at this rate.
Faisal, let's say I'm able to find that wallet. I'll pay you a finder's fee.
No, you don't have to, man. Just
Yeah.
relax. I shouldn't have said that on a recorded conversation.
No, that's a bit we'll let it
But yeah, man, like I think you can see, like, especially with some of the stories we've been talking about, like how I can see it as edutainment. Like I learn about how the world works. Huh?
This is an exciting world.
Yeah, like I learn about this world, but I learn about how our world works as well,
Mhm.
right? Like, HFTs, you learn about like institutional investors, right? And it's even institutional investors, man. Like if there's another story I can say that I think we were talking about this one not that long ago. It was pretty funny. So like these big hedge funds guy, one guy is, I think his name is Bill Ackman. The other guy's name is like something Icon, like
Oh, Carl Icahn.
Carl Icahn, yeah, Carl
Yeah.
Icahn. And like there was this a very funny thing of like, because they're hedge funds, so they're so removed. You don't like get to see like too much of these guys interacting.
Right.
But Bill Ackman, like, he's what you would call an activist investor. Okay. So first of all, apart from him being active in the sense that he has a hedge fund, right? Everyone
Yeah.
talks about passive investing, which is like you buy something like an ETF or whatever. You're super passive. You don't do anything.
Yeah.
But these guys who are like playing this game, quote unquote, for real, right? They're in there. They're very activist. So, when we were talking about like a stock represents some equity in a company,
Mhm.
in often cases it also represents ownership of a company,
Sure.
right? So
Mhm.
like, yeah, somebody like Warren Buffett, why he's so great is he actually goes and buys companies. He makes them very profitable and he makes a bunch of money at it. He'll buy something for $1 billion, make it worth 10 billion. He's made $9 billion, right? He's doing great. So Bill, like these guys, Bill Ackman, like being an activist investor, he came out and there was a company called Herbalife. I think the company still exists today. And he said, "Hey, man, this is an MLM scheme. They're just a marketing scheme. There's this giant Ponzi scheme, whatever." And he went on this huge like crusade of like,
Okay.
"Hey, this is a terrible company." And he shorted an insane amount. Like he shorted almost $1 billion in the company.
Oh, wow.
And so turns out he had somebody in that hedge fund world that didn't like him. I guess I guess that's what it is. And
Sure.
Carl Icahn was like, "No, you know what? I actually think Herbalife is great." And what
Okay.
he did was he took the other side of that. And he
Oh,
and he bought a bunch. Like he bought a bunch of Herbalife. And why I'm mentioning this story, like just thinking about different stories that I find very entertaining, is these guys actually came on CNBC and they literally had like a fighting match on CNBC.
what?
Well, a fighting match and how like rich people have a fighting
No,
match.
but I get it. It's verbal,
Yeah.
but it's literally two big whales taking the opposite sides in an argument, and one
Yeah.
one of them is gonna obviously lose.
Yeah, and it's on CNBC. Like it's like I don't remember how long the call is, but like if you look at it on YouTube, it might be very entertaining for your listeners to just play like a snippet of that call. But like there's a point where I think Carl Icahn is talking to the reporter, and the reporter who's like the mediator between these two, and he's like, "Don't you bully me. I'm never gonna come on CNBC again." And it's like, oh my gosh, what is going on, you guys? And like you can actually hear in the background too that there's other people on like the CNBC news desk or like close to the trading floor that are listening to this thing, and they're literally going, "Oh snap!"
That's hilarious.
Yeah, it's very funny. In the end, though, Bill Ackman lost that, and he gave up on his short, and he lost almost $1 billion on that
Oh
trade.
Jesus, dude.
Yeah, I mean, I don't feel bad for him. He's got other billions.
Right.
You know what? I guess it's all fair. It's all fair. You know why? Because Carl Icahn, because of the coronavirus stuff. Did you know Carl Icahn was one of the bigger large holders in Hertz?
No.
So Hertz has filed for bankruptcy recently. So he lost like a lot of money just in Hertz alone or something.
Oh, I see. I mean, again, like I'm not weeping any tears because he's sleeping on billions.
I mean, coronavirus itself has gotten like some amazing stuff going on, right? Like, amazing in the sense of like what is happening in the world. Like, for example, oil prices went negative.
Oh yeah, I heard this specific phrase, which I didn't realize what it meant. Oil futures are negative for the first time.
Yes. So it's.
What does that mean?
Yeah, let me think about how to explain this. So I think the best way to think about this is, and take these explanations with a grain of salt, because I don't, like I said, but let's go back to, and this is why I wanted to talk about certain fundamentals of the app market before, because they really ground a lot of these conversations.
Right.
So we talked about options, right?
Mm-hmm.
Now, when you get to something called the commodity markets, so oil is a commodity, gold is a commodity, like these are all these types of markets. You trade in something called futures. You can trade in futures. You can trade in spots also. Futures are similar to options in that they are contracts.
Okay.
So trying to remember like what they usually, like if you like were to Google this and like look up like Wikipedia articles or something, they usually say like, hey, Farmer John wants to sell his wheat 6 months into the future, right?
Gotcha.
But he wants to sell his wheat 6 months in the future because he knows that's when his harvest is going to come. But he likes the price of wheat right now. He doesn't know what's going to happen in 6 months.
Right.
Maybe everyone's going to sell their wheat in 6 months.
Right.
So what he can do is he can go and actually have a futures contract, which is created and have somebody out there basically say that I'm going to take delivery of your wheat in 6 months for this price.
Gotcha.
So he's good. He's ready to go.
It's like an option, but it's grounded in some real world asset changing hands.
Yes, and the key words there is changing hands.
Okay.
So especially with like how oil futures and things go, is you actually have to take delivery of said asset if it expires. Or if it goes there. Usually, what people are able to do. People are able to say, because the market is fluid, you're able to sell the futures contract and then roll it out and buy another one like much later on. So people who are just trading can do this and they don't actually have to take delivery or anything.
Yeah.
But that's what the contract actually implies. You have to take delivery of something. So while coronavirus stuff was going on, what was happening was nobody was moving, right? Flights stopped going, ships stopped going, people weren't driving.
Yep.
But I don't remember who was beefing at the time. I think it was Saudi Arabia and Russia. I think they were like beefing at the time. And they're like, you know what? We're just gonna keep producing oil. We don't care. So you have all of this oil being produced, but at the same time, nobody's taking it.
It's
right?
getting stockpiled.
Yeah. So basically all the oil storage ends up just like piling up.
Yep.
And I think what's important to understand is like when oil prices went negative, they went negative specifically on I think it was like the benchmark was like WTI, West Texas Intermediate. So you have different benchmarks. Like you have Brent and you have all these other ones. I don't know if you have all these other ones, but like what it represents something very real though, because like WTI, I think what it is, it's like they're out in like Oklahoma,
Okay.
right? And they have a limited amount of capacity that they can take.
Okay. Of course.
And so like they were expected to reach capacity by like sometime in like June or May. So you have all these people holding these contracts to take delivery of oil, and West Texas Intermediate going like, where? Fam, where do you want to store this thing? So then what happened is those people started going, yo, we need to get this off our hands, right?
Before storage runs out for people to buy. So basically, they are used to selling their futures to these places that can actually store oil. And those places like to buy them because they have a stable market price for oil.
Yes.
But now because the storage is going to run out, the storage guy's like, dude, I can't buy your oil.
Yeah, exactly. And what happened was at some point, these traders start going, shoot, I don't want to be legally obligated to go pick up 1,000 barrels of oil. All right, that's going to cost me a lot of time and money and all this stuff. So they're like, yo, I don't care. I'm going to lose money on this trade. Give it away. And it went so down that literally it became negative in the sense that somebody would pay you money to take this contract if you just took on the obligation of taking up the oil.
Oh my God. That's insane. Yeah. Okay, I get it now.
Yeah. And you know how we talked about, you know,
happen to be someone who just has an oil silo sitting around. That's the deal for you.
That's the deal for you. You know, wrapping this in with a few other thoughts from earlier, for example, Wall Street Bets had a great meme, which was like, hey, you want to know how to increase the price of oil? And it showed a picture of 2 barrels side by side. Okay. And one of them was labeled negative $30, and the other one was labeled $5,000, and it just had the word Supreme on it. They're like instant profit, risk-free money.
I see why you like that place.
You see why it's like it really ties in like the world events with like just like some like 5-year-old meme of like a 5-year-old created a meme. It's like funny. It's just like what is going on? Hilarious. But like I think I'd like to tie that with another thing is like, you know, how like basically these brokerages or, you know, can like also like we talked about exchanges not functioning, right? Brokerages, just like Robinhood, as we were talking about earlier, also don't function, right? So like there was a brokerage where this guy like he trades oil futures, right? And he's watching the price go down. It's going down. It goes hits a cent. He's like, yo, a cent? That's what I'm talking about. And he just keeps buying while all this is happening.
Okay.
And turns out like, you know, there's a whole glitch in their software, right? And turns out the price is actually already negative. And what happens is at the end of that, what he ends up owing several hundreds of thousands of dollars.
It always ends like that. That's what I learned from all these stories. It always ends like that.
But the thing is for them, since it was like specifically they were showing a price of 1 cent versus like the actual negative price, because their software had just never been programmed to handle that. I think like, I don't know exactly where that ended in, but like he could probably fight in court that, hey, I'm not, you know, responsible for this.
But that's a funny indicator that the software didn't even expect that number to be negative.
Yeah, right.
So certainly people didn't expect that number to be negative.
You know, a lot of these, you know, I was talking about Wall Street Bets. I didn't talk too much about the fintech twit community.
Oh yeah, communities, right? Multiple.
Yeah, but like, essentially, that's just me on Twitter. I follow a bunch of finance guys, and they just say like interesting things. And me there, all I'm doing is I'm like favoriting and liking tweets. It's very interesting for me to look back and say like, oh, this was the mindset at the time. This was the mindset. This is what people thought was going to happen. Did it happen? Did it not happen? And you know, some people are very poignant. And it's also once again a very entertaining thing to do. I think other areas that I really like to like learn and like look at, you know, if people are interested in looking at this stuff, is like, for example, one of the podcasts I listen to is like Chat with Traders, and it's this guy who literally just does a podcast with professional traders, and he'll go on many different topics. He'll talk about many different things, and like they get very concrete. And when they get very concrete, it's very cool to know. Like, For example, we talked about I don't do day trading, right? But there's people
Yeah.
that do day trading.
Sure.
By listening to some of these things, like you realize, like, hey, what does it mean to actually day trade, right? Like you see Wall
Like
Street bets,
in the weeds, like what does it mean? What are you
yeah,
doing it?
yeah. Like when Wall Street bets, like those guys are out there day trading. Some of that you can say is akin to gambling, okay? But like, when you look at it, like how these professional traders talk, like I think one of them, there was like a great one about like risk sizing. Risk sizing is something you got to do as a professional trader. Like
Mhm.
when you are trading as a person regularly, like day trading, it's literally a business. You
Right.
need to have a lot of discipline.
Right.
What comes with the business? Bookkeeping,
Mm-hmm.
right? You got to be
Mm-hmm.
very strict about your bookkeeping, right?
Mm.
Like there's one guy who's talking out there is like, for example, if I made my binary decision of I'm going to do well in a day or I'm going to do bad in a day, am I going to positive or negative, right? Let's say
Mhm.
that's 50-50, he says. If I have 4 down days in a row, this is 0.5 to the power of 4. It's a 6.25% chance, right? He's like, now I'm 2 sigma day, like it's a 2 sigma deviation off. So my 5th day, I got to take off because I'm so outside my standard deviation of operating that it doesn't make sense what's going on.
Okay. Okay.
Things like formalizing, like if you're going to be a professional trader, you got to formalize direct risk sizing. Okay. So like one thing people will say often is like 1% is your max risk size. What does that mean? So like they were talking about that in a podcast, right? Like, so say your account size is $25,000. Okay. 1% is $250. Okay. So say you're buying a stock at $50 and you
Okay.
have some reason, such as maybe the closing price yesterday was $49.75. And you're like, it's not going to go below that. If it does, I'm out. Right.
Okay.
So it's 25 cents.
Yeah.
That's your difference.
Mhm.
Right. So you're buying at 50, but you're going to risk only up to $250. So you'll buy however many shares with that 50% differential, right? And so you're risking your max risk size is $250.
Okay.
But what's your upside? Maybe you're looking for a move up to $1 or $2. So you're risking $250 to make 1,000, to make 2,000. Okay.
And you're literally actually framing it as a bet with probabilities and expected outcomes.
Yes. And so your max pain, the idea is your max pain is always fixed.
Okay.
So very much completely different than Wall Street bets about due diligence, like, oh, I'm going to do this and based on these emotions. It's like you don't overthink. You have a process, you have a size, and you show the results, right? And you can see like you're risking 250 to make 1,000, right? For example,
Right.
you don't need to win on all of your trades to make money. In fact, you only need to win on a fraction of your trades to make money.
Gotcha.
So even if you're only winning on 30% of your trades, you're doing good.
As long as your potential loss and potential gain, the multiplication factor is more than your percentage of loss versus your percentage of win.
Yeah.
You're
So the
always
idea
gonna
is
get out positively.
like if you're doing 1% max risk, and you are doing many trades,
Yep.
over time that should average out for you winning.
But the
Right.
potential gain, let's say the potential gain is 4 and the potential loss is 1, then you can tolerate, let's say, 75% of your trades going bad.
And then that should still put you at just break even.
That sounds very reasonable.
Yeah. So like, but that's the thing. When you're day trading, like it literally is a business. You have to treat it as a business.
So you don't do this approach, 1% max pain.
No, because like I went from different journeys, different parts of my journey as an investor, right? So I went from the early on, like, oh, I'm just gonna do whatever I want. Lost a bunch of money. All right. And then 2, I did try to play with like swing trading, which is not the same as day trading. It's like on the horizon of days to weeks and stuff.
Okay.
And I didn't do very well there either. Like I did like okay. That's probably what it was. I just did like okay. And in these ones, I was like trying to follow a little more of these types of systems. I was trying to be more codified.
Okay.
I think for me, where I've kind of like settled into is, and it's worked out well because of how tech is doing. Okay, that's it.
Okay.
So I will. This is the thing I'll caveat, and I guess I'll say the caveat before anything else. The caveat is that we've been in a bull market,
Yep.
right? So I've literally gotten lucky. That's
Okay.
it.
Okay.
But my formulation of thought has been, I look at tech companies who are in the fairly like low billions,
Okay. In
right?
terms of market cap.
Yeah, in terms of market cap. And I look at that and I go, okay, I understand the underlying technology and business,
Mm-hmm.
and also my business side of things of like, hey, I think I understand this appeals to the consumer, this doesn't appeal to the consumer.
Mm-hmm.
And from there, I'm able to just say like, oh, I think in this much time it's going to be worth this much. So then I buy it and I hold it, right?
And
So
that's kind of like
all,
the Shopify example.
huh? Yeah,
Kind of like the
e-
Shopify example.
exactly. And with that, like, comes very much an idea of you do all of this work of like knowing market sentiment, what's happening, all the players, all the technology, all of this stuff that I do, and you'll only make like a few big moves in the year. So you're doing all of the work throughout the entire year
I see.
to only do a few things. It's not like I wake up every morning and go, all right, yo, I got an idea that I'm ready to work. It's like, no, 90% of my time is just like absorbing, like seeing what's going on, understanding what's going
I
on,
see.
and like learning. But
Okay.
like, yeah, Chat with Traders is like, I think, a really good podcast.
I'll
There's
put a like all the links in the description, like
there
the
there's
podcast book.
there's another podcast that's really good. I would actually say, just to understand what happens in the macroeconomic world and all these topics. It's called Masters in Business. It's by
Okay.
Bloomberg.
Okay.
They do a very good job. Like, I think recently they just had a really good episode with I think the guy's name is Jeremy Siegel.
Okay.
And he actually goes into very detail about like what he thinks the macroeconomic trends are happening around COVID. So like he's taking a stance, like he brings a lot to be able to say it. Like, he's like, oh, he personally thinks inflation is going to go up. Like, he thinks asset
Mm.
prices are going to go up and all this stuff. And it's very good to like listen to it and understand what's going on. One thing I've learned is, in general, this is just my take on it, but you'll see, like, whenever you talk to people about the finance communities and markets, like you ask people opinions on stock, you'll find that people who speak with the most certainty about in the future, like most certainty about what's going to happen in the future, are the people who don't do this often. Like, they haven't gotten their butt kicked enough.
Gotcha.
I feel like they're literally repeating like their sound bites that they've heard, right? And it's like, yo,
they're like Irony Man.
they're like, well, I would say Irony Man is actually probably like a level above. Like, he went deep into it, right? Like, he at least did something. Like, if you ask him about a box spread now, I bet you he'll never get it wrong. The guy who's repeating the soundbite, I bet you he'll still get it wrong.
I gotcha. I see what you're saying.
So that I really enjoy. And through those kind of areas, like, you find people who are in the finance industry, and people you might want, like, for example, if you think Jeremy Siegel's awesome, you may start following him, right?
Right.
I think
Right.
one of the guys that I really follow a lot, because he's so good. His name is Kevin Muir,
Okay.
and I really enjoy following his stuff. Like, and
On
not
Twitter?
all, no, he has Twitter, but he also has like his own little website where he does like a little newsletter. And not only does he explain like very deep things that are happening in the market, so like deep financial market concepts, but he also has great memes. Like, he does it also through memes. He's so good. Like, he's one of those, like, oh man, you understand it so well that you can literally just throw humor at it.
Masan, why don't you have a blog or a newsletter or something?
I don't think.
I mean, you talk about it in a very entertaining way, I must say.
I see. I don't think I've really thought about it that way. Two, I also, like, having listened to these people, it's like, man, you guys do a good job. I don't think I could do that good of a job as you guys.
Because you're following some of the best.
Yeah, and yeah, like, Kevin Muir actually talked about one story in a recent one. I think while the oil stuff was happening, that was very entertaining. Because he's talking about his time in the trenches, right? And he talks about one story where he's like, Yeah, man, there was something similarly happening where, basically the price was going negative in these future commodity markets. And the reason it was going negative was because if you took this future contract, you were obligated to pay money or you were obligated to do this thing.
Mm-hmm.
And he said one of the smartest traders he saw was a guy who took this, right? And so he bought a bunch. So he was getting millions of dollars at the time for taking the trade. It's like taking it off their hands. And then they came back to him. They're like, all right, pay up. And he's like, make me. And they're all like flabbergasted, like, no, you can't do that. No, that's not a thing. He's like, make me.
He called it bluff.
And then, so like while they're fighting about all this, in a few months, the prices went back up. Great. They were doing well. Sold it for a huge gain.
Oh my God, that's genius, though.
Like literally, man, some of the guys that do this, like the world is like their playground, right? Like
you gotta be self-confident though. Like you gotta just be like, I know what I'm doing. I'm gonna dig in. I'm gonna double down.
It ends up being awesome, man. I think if people like really enjoy like kind of listening to people and their stories, like I think 2 books that I would really also recommend is called one, The Market Wizards, and there's there's actually a sequel, which you're not ready for this name, all right? Are you ready for this completely extremely original unexpected name?
No.
The New Market Wizards. But it's a guy who essentially just interviews people who have done extremely well, like over a long period of time. It's not like, oh, you've done well this year.
Right.
Because he has an underlying hypothesis, which is that these people have figured out something in the financial markets. They figured out some edge, and they've done that through many years to have made money. And so it's all interesting to hear people's perspectives about their background and all this stuff. A recent book I started reading recently is like called Reminiscences of a Stock Operator. And this book was written a long time ago. This is from a guy who like traded before any of this electronic stuff was like 1900s.
Oh, wow.
But like some of the stuff he ends up talking about ends up kind of being very related to like what are the very, very fundamental pieces in a trading market.
I see.
And he talks about just his journey. Like he's just reminiscing. He's like, oh, I started off at these betting shops and I did this thing and I did this thing. And it's just an entertaining read. But yeah, Michael Lewis is really good. A lot of his books. So that movie that's very popular, The Big Short, he's the one that wrote the book.
Oh, I see.
Yeah. Wall Street Bets, these guys will like, they'll use Big Short as like their ideal hero. When they're making a short move, they are the Big Short. They're Michael Burry and all of this. So.
And this is the kind of stuff that you just absorb basically as background waves, like all the time. So then when it's time to make that 1 out of 5 moves per year, you feel informed.
I just mentioned the name Michael Burry, and I think it would be interesting because there's a whole thing about, we didn't really talk about it, but passive investing versus active investing.
Sure. How bought into ETFs I am. I want to learn about that.
Michael Burry, he has strong opinions on what he thinks ETFs are going to do to the market in the year's future. And I don't think I necessarily know enough about the markets to like make a like, oh yeah, this is definitely what's going to happen. But his premise is, ETFs, the ones that most people buy into, the safe ones, right, are tracking an index.
Yeah.
Right. And if they track the index accurately, the index is weighted by the market cap of this company. So like a move in Apple means way more than a move in like stock XYZ that's not worth that much in the index, right? Well, when ETFs just do that same type of investment, his argument is essentially that, hey, by such a strong inflow of money to ETFs, they continue to put that same distribution of large market cap money into those large market cap stocks.
Right.
Which then feeds more buying activity, which then feeds more ETF activity.
I see that.
Yeah. So that's like his argument of like, what happens when these things need to change? Like what is true price discovery? What happens when, things need to go on? So it's like, and I don't know enough about, I think, the very deep mechanics to say too much, but
Okay.
like that's kind of where it goes into. So I think even for people who are completely just passive investing, it's enough to be like, you should just understand what goes on. You know, like I think a lot of people, they hear ETF and they're like, oh, ETF is always the right thing to do. But
Safe.
like ETF itself is a very complicated financial instrument too. You can
Mhm.
have very complicated ETFs,
Mhm.
right? There's people out there. So like, for example, Kevin Muir, he had a really good post that he did where he looked at the huge price and rise of Tesla, and
Yes.
he exactly correlated it with ETFs that are, I think they're called like ESGs, environmental, social,
Right.
like corporate, like those kind of responsible. So like green ETFs.
Uh-huh.
And he's like, you could exactly correlate the inflow of money there and the rise of Tesla, because he's like, hey, look, Tesla is like one of the best bets for that.
Oh, I see what you mean. So by the very, as a consumer, when I buy an ETF, all I am thinking about is this reflects the market price. I'm just buying the market price.
Yeah.
Whereas what's actually happening is for some of these more nuanced ETFs where it's like a specific sector of the market, you actually end up boosting that sector of the market, which makes you think it's doing better, which makes you buy more and so on.
Yeah. Yeah. So yeah, his so then you go to Michael Burry's argument, which is like, hey, if you do that for just large cap stocks, and there's a huge concentration of large cap stock, and they represent pretty much all of the S&P 500.
Hmm.
You know what happens when one of these either breaks or something happens,
Too big to fail.
right? So it's just like, I mean, hey man, he was able to call out the housing industry with this, right? And housing industry was completely safe.
Yeah,
Uh,
supposedly.
that
Yeah.
that being said, none of these guys, you always look at everything and you always look at it with a grain of salt. Because also, Michael Berg has made very interesting statements about coronavirus.
Okay. Okay. Is he
So
like Kevin O'Leary, where he's like, "Oh, 3 billion people being in poverty is great news." Have you heard of that one?
I
It's a
haven't
Shark
heard.
Tank guy.
I
Shark
haven't
Tank
heard. I've heard the headline, but I haven't heard him actually say it.
I saw the clip, but yeah, I know what you mean. It's basically like they see it as an opportunity.
Yeah. So I mean, there's so much, but like, yeah, I think these are some like things maybe that gives you an idea of the different things that people can kind of learn for entertainment, at the same time like educating themselves and understanding what's happening, like, and taking some ideas of like empowering themselves, like financially what's happening. Even if you just do ETFs, even if you do passive investing, it's good to understand what are these underlying mechanisms to some extent. And if you don't, at least you and even if you don't, at least you get some entertainment out of it.
I would say if you have a 401k, it's probably good to understand what are your stocks that you are invested in for your 401k, right? And those are generally some of these index funds. So
Yeah.
it's good to educate yourself on that. A lot of people a lot of people have 401ks.
Yeah. Hmm. So that's that. Um, let's see.
How are you feeling in terms of strength, Faizan? I can keep going as long as you can keep going.
I mean, there's some other stuff, but like, I don't know. I feel like it's one of those, if we start talking, it's like another like 20 minutes, Like, I think
Let's
some
do
things
one more. Let's knock out one more.
Let's see. Because I'm between two of them right now, which is either we can talk a little bit, just a little tiny more about either index funds, or we can kind of go down talking about all the stuff with coronavirus and like, what's it called? Some of the stuff the Fed has been doing recently.
Oh, let's talk about that.
You
Let's
want
talk
to
about
talk?
that.
Okay.
Yeah.
So the Fed has just been like pumping in money, right, into the markets.
Just printing money.
Yeah, I think everyone has heard that. Like,
I've heard it.
Like, yeah, what does that mean? Like, what's exactly happening here? So all the stuff that went to stimulus to like help out like normal folks and things like that, that very tiny fraction of the money. During this time, like coronavirus, the Fed has essentially been buying up large amounts of assets and like basically providing large amounts of liquidity to the market.
Okay.
Right. It's like I think their balance sheet is close to $6 trillion, has ballooned close to $6 trillion at this time.
Wow.
So it's
that's
insane.
That's how much money they have put out.
Yeah, that's how big their balance sheet is. In fact,
Okay.
if you have seen some of the recent rockiness in the markets, so like specifically, the market's been frothing. It's been growing up. It's been going up, right? But the last like week and a half, it looks like it's like kind of pausing and like chugging a little bit, right?
Uh-huh.
And I find that very fascinating because it exactly overlays the Fed stopping expansion of their balance sheets and actually like it shrinking by just a tiny amount.
Okay.
So there is very much an idea of like while all this stuff was happening with coronavirus, like you were sitting there as an investor going like, what should I do? Like if you're somebody who's like a long-term investor, obviously nothing matters, right? But if you're somewhere in the middle, you're like, I like to, buy and sell occasionally. What do you do? Should you buy more? Should you sell more? What should you do? Um, and when I was following the FinTech community, these guys who are very active, they're like, it became very clear to them as soon as the Fed started stepping in, especially some of the bigger guys that follow, they're like, the saying was, don't fight the Fed. The guys who really understand the mechanics of these markets, they say you can't fight the Fed. The Fed has an unlimited balance sheet. If the Fed wanted to go from 6 trillion to 12 trillion tomorrow,
They can do that.
there's nothing stopping them.
Yeah.
And as long as America is a creditor nation and we have the strongest amount of natural resources, strongest amount of service industry, strongest amount of like military to back all that up, like you're
Uh-huh.
good. You're good. And so it's very interesting. Like, don't fight the Fed, and this is the caveat. He said, don't fight the Fed, but you should pay attention to what happens when they need to unwind those positions. Who's gonna buy? Are they ready to buy?
Gotcha. Because they will eventually want to give those assets back for some money.
Yeah, and in fact, what happened in like I think it was like 2018 when there was like a little bit of not a little bit, it actually did decline pretty far. Was a lot of it the Fed raising rates, but also decreasing the balance of their,
Gotcha.
so they were really heavily unwinding, and they're like, oh, that's not a good idea, and then go back up. It's like we gotta start taking this. So I think we are in a very interesting place. I mean, in terms of right now where I am, like with my own money, like, I mean, I'm invested, right?
Mm-hmm. Mm-hmm.
Like a lot of those companies that I had opinions on, like a lot of it stayed the same. I've personally taken a stance on ever since like 2018 was happening because like I do have the mindset of like I've just been lucky. And what happens when this bull market needs to change, right? What happens when the bull market needs to change? Am I going to be completely out of it? And so because of that, it's I think the best way to describe it is like I stay like cautiously optimistic.
I think that's good. I mean, it also depends on how old you are, right? Like if you were 60 right now, I think you would feel very differently about your liquid assets versus your non-liquid assets as opposed to how you do now, right? Like, because you don't need a bunch of money starting tomorrow. You have a job, you're financially stable. A lot of the investment money can stay tied up for a while.
Yeah, that totally makes sense. Now, I'm not saying 100% at all that we're close to .com levels because we're not. We're really not. There's many people who are way smarter than me that have written stuff that we're not close to that.
Okay.
But I just think whenever you're 100% certain about everything, especially when it comes to the financial, because the financial markets are not like you turn over a rock and you've discovered like this is the truth. These are all like man-made financial systems and rules. They can all fail in ways that we 100%. It's not a law of physics.
No, yeah, I get it.
Right?
Of course. Yep.
So 100%, you don't need to pull the money out for like 40 years. You should be fine. Right? But it really sucks to tell somebody that who invested in like Microsoft before like the .com crash, right? Like what did their money do for 20 years? Right?
Yeah.
They invested in companies like IBM.
Sure.
Right? So it's like that's really rough to say that. I I think because I recognize the weakness in the fact that I'm not just doing a giant ETF that is rebalancing itself, and I have individually picked stocks, I'm
Yes.
kind of positioned in the place where I should be cautiously optimistic.
Because it was always about the value that company is going to provide. And many of the companies you are invested in, coronavirus or no coronavirus, in a year, 2 years, whatever, you see them actually providing more value.
Yeah.
That sounds like a smart way to invest, to be honest. But
I mean,
hard. You need to
I
know the company's details. You need to know the industry.
yeah, like I said, a lot of this me absorbing information, like, sometimes it's extremely beneficial for me based on that perspective I have. So, for example, I was pretty much 80% cash by December, and that
Okay.
happened to really line up well with what happened with coronavirus.
Of course.
But this had all been coming around from a feeling back, like all the way starting from like 2018 when things were happening with the markets.
Mhm.
It just seemed like with corporate buybacks increasing and all of this stuff, it just never felt like we were on solid financial footing. Like everyone's looking for the exit door. That's how it feels. And like a catalyst happens that describes the exit doors, and everyone's like rushing out quickly.
Of course.
That's
Of
kind of
course.
how the feeling has been, because after such a long bull run and increasing rates and unwinding sheet, that's all that was happening. I think the bigger things that I was seeing was people way smarter than me in these fintech communities talking about increasing repo operations. So that's basically the
Like
repo.
repossession of assets.
The repo market's a little bit different. They call it the repo market, but it's not exactly repossession of assets. In a way, it kind of is. Ever since, I think I'll explain the nuance part of this. The nuance part is ever since the great financial crisis, there's been different like requirements on banks on how much cash reserves and stuff they need to have, right?
Mm-hmm.
And because of that, you can. What's the best way to? You can like you can. Hmm. I think roughly what it is like you can you have some assets on hand, right? The Treasury Department or like the Fed will agree to take those assets off your hand to give you cash for a while. So it's a repossession in that sense.
Oh, I see.
Right? But that gives you a lot more cash. A lot more cash for your financing activities. So the size of the repo market in terms of how much the Fed was helping these big institutional guys by providing billions of dollars in liquidity has started growing very, very large starting from August of last year.
I see.
Very, very large. Okay. Right? And it was getting to numbers that I was uncomfortable with. Like you were talking like 600 billion in a month, right? Which at the time of the great financial crisis was like kind of like it was the same. It was like, really hitting that peak. And so because of that, it made me really uneasy, and I had to make a very uncomfortable call, which was like, dude, I've been making a lot of money here, but since I want to do something with that money soon enough, I'm kind of in a position where I might hate myself, but I think for the next like 6 months to almost a full year, I might have to keep my money cash because I don't know what's happening and it seems weird.
So you're telling me coronavirus or no coronavirus, just it happened to be that the economy lined up in a way where you were mostly cash.
It's just like you see it's like, it's like you can't like see what's exactly happening in a room, but you can like hear the noises. And you're like, this sounds weird. And I don't know. And that's the thing about any market crashing, right? Like you're always going to have a melt up at the end. So you're always giving up a large amount of money. So I remember when I went to 80% cash in December, there's other people I talked to and they were making money every day. And I was going, oh, that's so painful. But like, I personally think I think coronavirus was a huge catalyst.
Sure.
But I think the kind of state that we were in, if it wasn't coronavirus, there would have been another catalyst.
Yeah, that's what I was thinking. Yeah.
right? And whenever these things happen, I think people always look back and they point at like, oh man, this was the thing that caused it. But I think people who you see are more like educated in that area. They're like, no, this was the catalyst.
I mean, I agree with that. It's similar to the great man history theory of history versus just like forces of just natural civilizational forces. Because if that one what was his, Archduke Ferdinand, if he hadn't been assassinated, World War One
Mhm.
still would have started because all these European nations had just developed. They have a tons of weapons now. They have national identities that have been forming. Something's gonna catalyze it.
Mm-hmm.
Yeah.
So, I mean, I don't know. I still call it lucky. I think I was very lucky.
I mean, take,
Um,
take what you can. Take what you can, right? Like that's what I'm gonna say.
yeah. So it was that, and then like finance guys being like, "Hey, don't fight the Fed." I'm like, shoot, that kind of makes sense. So all this stuff's going down, and I'm picking it up, and like yeah, it's turned out pretty well.
Okay.
Yeah.
No, yeah, that makes a lot of sense. And also, I mean, I'd heard about these things like the Fed is pumping a lot of money, but now it makes more sense to actually what they're doing.
Yeah. Um. So yeah, I think it's a lot of interesting things that are going on, and that's why I find it very fun to like follow along and see what's happening in the world. It's not just like this and that.
No, I think after this conversation, I have a much deeper understanding of. I think previously, to me, it was I saw two aspects of it. One was obviously like personally, you want to do well financially, and secondly, you saw a lot of entertainment opportunities here. But I think it goes way deeper than that. It's like a whole worldview. Like understanding markets is understanding the world.
Yeah. And it ends up being very ends up like you're saying the edutainment aspect. I don't think it's something I expected when I first got into this.
And
So
when I link all the links in there, I think that'll make it pretty clear that it can be very entertaining, especially the the meme aspect of it. I let people have the parting thought though, Faizan. So I'm gonna open up the floor to you. You can say whatever you want, and then we'll say goodbyes.
I don't think I have any particular parting thoughts, man.
Knowing you for many years, I know how you love being put on the spot like that.
No, I don't think I have any particular parting thoughts, especially because like I think we talked about so many things.
Okay. Yeah. How about educate yourself? Go to personal finance before you go to Wall Street bets. Follow the flow chart. Get to a 401k.
Yes, yes, yes.
Have
That
some
makes
money.
sense. That makes sense. I think yeah. Actually, that is a good way to put it. So yeah, in terms of parting thoughts, like yeah, while this is really great and stuff to do, even myself, like I've said that I don't do options, I don't do these things. So when you kind of look into these areas, like it may seem very exciting to just jump in and start doing it, right? But please be very careful about any money that you put in. Like I still have a 401k, you
Sure.
know, in
Yeah.
my 401k, I take all the very safe strategies,
Yep.
you know, no crazy like stock picking, selecting there,
Yep.
I kind of like diversify based on that. So similarly, when you are going into this, there's a reason why the safe advice comes from many, many, many years of experience and from people who really understand it. So yeah, like very much Wall Street bets and all this stuff. Take all that extreme stuff with a very, very, very big grain of salt. Investing, other investing communities, understanding your personal finance. These are all way better steps to take first.
I think that's great. And in fact, I think if I were to boil down my understanding of everything you have taught me today, it would be a statement like it's really awesome to learn to minimize risk because that will also teach you to make money. Like don't just go after don't go after somebody who tells you like I can 10x your money. First learn all the ways you can mess up, you can lose money, and then make accordingly the decisions because that's what's going to break you, right? If you can't pay that $57,000 and you're just left with like that's not good.
Yeah.
Oh, man. Thank you so much for your time, Faizan. I hope this was as wonderful for you as it was for me.
This was fun.
Wasn't it? This is hella fun. Doing this is so fun.
Yeah. I mean, I hope there's a second portion and you come back and you talk to people again.
Oh, I will. And in fact, I think all of the people that I know, including yourself, you all have rich personalities and different interests. And I know this is one of the things that you're interested in. But for example, one of the big things we didn't touch upon today is how does this all play with Islamic banking? How does this play with if you want to do things very differently? And I think I would love to have you on a return episode to talk just about that.
Yeah, that would be fun.
Awesome. Thanks for your time. I hope you have a wonderful rest of your Saturday.
Dude, I hope you have a great Saturday, man. This was fun.
you.
I actually enjoyed this way more than I thought I would.
Dude, that's if nothing else happens, that is the point of doing this. Is for the people who are talking to have the conversation that they wanted.
Yeah. Cool, man.
All
You have a
right.
good day.
Take care,
Be good
Faisal.
day.
See ya.
Bye.
Bye.